With $6 billion of capital at his disposal, Mick Davis is the man everybody wants to talk to in the commodities industry. I spoke with him about commodity markets and potential acquisition targets. Mick, could you tell us a bit more about your motivation for launching X2 Resources? I mean, why do this?
Well, look, I guess because I have a conviction in the sector. Primarily, I think that what we're going through now is the result of a supply response to a significant burgeoning demand driven by China over a decade. And that response was late in coming, but then it came very profoundly for reasons which, if you understand the industry, you can understand why we've got into the situation where there's now sort of supply increasing at a more rapid rate than demand is growing, and that clearly has led to retracement of prices. And an industry which has lost faith in itself, and investors have lost faith in the industry. But I have this conviction, so I see an opportunity of acquiring assets at reasonable valuations and growing their value proposition. And I sort of like creating value, and otherwise what was I going to do with my life?
But you've chosen private capital to fund X2. You've not chosen the public markets this time. Can you tell us a bit more about that decision and why private capital might be more suited in this current environment?
Well, I think actually that the traditional providers of mining finance, which was the public markets, I think that the character of those markets has changed. The people in them have changed. The way they pursue value, the way they think about the time frames of value creation have changed. So when I first started getting into the industry way back in the early 90s, and with Gencor, then Billiton, and then subsequently with Xstrata, the natural port of call was the public markets. They delivered cash efficiently, quickly, and they had a view about the sector which was congruent with the way the sector actually operated and the timescales that the sector needed to actually create value. Whereas today I think that short-termism has become to dominate, and the value creation profile of fund managers, and given the way that they measured and the way that they tracked, is not congruent with an industry which has sort of life cycles of 20, 25 years of assets. And so we now have an industry which has no conviction in the sector, thinks that it's run by a bunch of muppets, wants to withdraw their money as opposed to investing the money. And therefore me to come along and say, back me, seemed to me to be a tough ask. And also, I didn't want to be backed by people who turn around to me in 6 months' time and saying, well, why aren't you doing this, or have you done that, or should you do this, because we're under pressure. And therefore it seemed to me that raising private capital with people who had a long-term perspective, who didn't need funds returned, who were comfortable with the time frames, and provided that they shared my investment conviction, and also that they had faith, the fact that I could steward assets well, it seemed to me they were the right people to go to.
Okay, I'm talking of capital. You've raised, what, sort of $6 billion-ish now. I mean, two questions from that. Do you feel under pressure now to spend that? And how much leverage can you put onto a sort of a mining business?
No, I don't feel under pressure to invest it precipitously. I mean, and I think that we've been quite careful in waiting ever since we started this process. So we've engaged with the opportunities, but we haven't decided to press any opportunities, because I just felt that conditions would move more in our favor, and I think that has happened. I think probably this year is, if I look at it, and if I look at where multiples have gone to on listed entities, and I look at what is becoming available in sort of potentially bilateral private transactions, I think this year seems to me a year where I think deals will be done. But I don't feel under pressure. My investors are not putting me under pressure. I mean, I think they are very comfortable with the approach that we've taken, and they're very comfortable with the metrics that we have and the way that we are seeing the sector. On your question of leverage, I mean, I think that very much depends on what you buy. Because leverage is a function of the cash that is generated by the assets and where those assets are in terms of their life cycle. So if we're buying assets which are going to need a fairly early on injection of capital to promote the NPV, clearly you can take less leverage than assets which can give you a longer period of cash flow before you need to reinvest. And I think the trick is to put a combination of assets together which should allow you a reasonable amount of leverage to give you the capacity to do the scale of investment that you want to do, because as you build the scale, so you build your optionality. So I can't give you an answer to say we can do sort of 3 times EBITDA, 3.5 times EBITDA. It just very much depends on the asset mix, and the trick is to get the right sort of asset mix, which give you optionality in growth, but at the same time sufficient cash flow generation to give you the scale to do of the sort of transaction that makes sense.
Okay, and just looking at assets, I mean, when you look at the marketplace at the moment, which commodities look most attractive to you at the moment, which sort of have the best fundamentals, or which might offer the cheapest sort of assets?
Well, there's an interesting question, you see, because I mean, I'm going to say to you what everybody say to you, that copper, zinc, lead offer the best long-term fundamentals, and for good reasons. I mean, they both have supply constraints, and they support both mid-stage and late cycle development. And so although in China the initial infrastructure phase in the main is not over, but has sort of passed perhaps its peak, as we get into a consumption economy, so these commodities play a different role. So I'm very constructive on those. But I think that if you look at the markets where people are completely out of love with, they offer interesting buying opportunities, and the thermal coal market is one of them. So you have a commodity which is at the lowest ebb in terms of investor confidence. It has a bunch of externalities around it in terms of people's concern about its environmental impact. And yet there are assets there in the right geographies which can supply the right markets, which could well be interesting. So I think that one has to be a very clear idea of metrics, but take opportunities as they present themselves, even if they're not opportunities the market immediately today would want to recognize.
Mick Davis, thank you very much.